Hello, everyone, and welcome back. My name is Michael LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management, and this is Mike on Money, our weekly videos that we do a deep dive into all things financial. And this week, we're going to be looking at the Canadian economic response packages, specifically for corporations, business owners, individuals, seniors, and even students. There are a lot of different benefits to take advantage of, but also a lot of pitfalls to avoid. And apologize for the different format this week. Of course, we're still doing social distancing for COVID, and we have a guest speaker this week, so we're using the Zoom technology to be able to bring her in. As always, the information that we talk about here is for personal use only. Don't take it as advice. Always seek the advice of a professional or do your own due diligence before acting on any of it. And we try to keep the information as up to date as possible. But these things are constantly changing, especially these economic packages are changing here in Canada. And it's always good to double check with a professional or on your own to make sure you've got the most current information. So with that, I'm going to dive right in and introduce our guest speaker today, Rebecca Hett from CI Investments. Rebecca's got an 18-year background in estate and tax planning. She holds her CPA designation as well as her CGA and also her trust and estate planning designation. She's worked with families, individuals. She works on a team that does estate planning work and tax work for people across Canada. But she's going to have to add a new designation to her resume after this, as she's done tons of research and brought a lot of knowledge to the economic response package here in Canada. So I'm going to turn it over to Rebecca now, and she's going to take us through all the different things we should be looking for and what to watch out for if you are planning to take advantage of some of these benefits. Rebecca, please join us.
Thank you, Mike, very much. That's a very generous introduction. I appreciate it. And yes, my team and I have been working very hard looking at all of the programs, the responses federally and provincially to COVID-19. And I do appreciate very much the opportunity to share what we know today with you and your clients ultimately. I'm just going to share my screen to get access to the slides. It does indicate the screen share is not an option right now, but the green button is on. So I'm going to try again. Host disabled participant screen sharing. I wonder if there's anything else we need to do. Just wait a moment for that to change. There we go. I think we're good. There we are. It's just coming up. We're just going to get the beginning slide. There we are. So economic response to COVID-19. Where do we go from here? On to the agenda. Taking a look. So we'll take a look at the federal economic response. We'll take a look at the provincial response, specific, of course, for British Columbia, and then briefly touch on some tax and estate planning concepts in conclusion. The federal response, this slide is always changing. The total as posted on the Government of Canada website, the most recent, is $765 billion across a variety of sort of categories of support. The programs that I'm going to touch on today fall into one of these categories, but certainly this number, $765 billion in terms of a Canadian federal government response, is a moving target, and we're seeing that number continue to rise. So the federal support, as it relates to individuals, the key program, the flagship program I might suggest would be the CERB, Canada Emergency Response Benefit. It is taxable. It's this income replacement benefit up to $500 per week for a 16-week period. You had to have stopped work as a result of COVID-19. You could not have voluntarily quit your job. It had to be as some reason related to COVID, and it's available for employees, self-employed individuals, and contract workers alike. You have to have been, with regard to the CERB, you have to have been at least 15 years old and living in Canada. The work that you didn't do didn't necessarily have to be in Canada, but you had to be living in Canada. To qualify, you had to have at least $5,000 of income in 2019 proper, or in the 12 months preceding the date of application. And this $5,000, it means pre-tax income, and in the case of a self-employed individual or a contract worker, it means net income. So it's not gross revenue, it's your income net of your typical deductible expenses against that income. You could not have received employment or self-employment income of more than $1,000 in at least 14 days in the initial 4-week period of which you are applying. And then subsequent to that, you could still earn up to $1,000 per week from those employment or self-employment sources. As I said, the benefit is taxable, no source withholding, so you've got to be budgeting for the tax down the line that will become payable in 2021. You apply now through the CERB portal, through my CRA or Canada.ca, through your My Account provision, and the benefit is available now from March 15th to October 3rd. We have until December 2nd of this year to apply. Continuing with the individual response federally, the RIF minimums, those RIF minimums withdrawal, reduced by 25% of the original. The reduction applies only for 2020, and it applies to all types of RIFs, including the locked-in plans that many Canadians have. Of course, taking this reduced minimum will mitigate our taxable income for 2020, leaving more of that capital inside the RIF to continue to work for us on a tax-sheltered basis. If you have already taken the original minimum from the plan for 2020, you are not allowed to recontribute it. So just some key facts there with regard to the RIF minimum, the reduction of what we have to take. Extra time to file tax returns. I wanted to leave this in because there's been some new developments announced late last week with regard to this. So if we are an individual, an employed individual, or otherwise an individual tax filer, our due date was April 30th. It was extended to June 1st. That hasn't changed. Similarly, if we're a self-employed individual, our filing deadline, it was June 15th pre-COVID, and it remains June 15th. But what has changed? Essentially now, we have our filing deadlines, but there's going to be no penalties or interest charged until September 1st. So we effectively have until September 1st to file these returns without having concern for late filing penalties or interest charges. And this waiver of penalty and interest also applies, to any elections or forms that we have to file with our tax return. One of the things I'm thinking of, T1135, for example, or other supporting forms and schedules. The deadline to pay any balance due is extended to September 1st. So whether we are an employee or a self-employed individual, in the pre-COVID days, our payment deadline was always April 30th. Now that has been moved to September 1st for everybody. If you want to receive, if you don't want any interruption in your GST credit, for example, or your Canada Child benefit, it is still best to file your return as close as possible to June 1st. As a temporary remedy, however, the government has recently announced that July, August, and September payments will continue on. They will not be interrupted, and they will continue on based on our 2018 return. However, if we have not filed our 2019 return by the 1st of September, such that there's nothing available for the CRA to process in early September, the October payments will cease, and we will be looking at having to return the July, August, and September payments until such time as our eligibility for those payments is recalculated based on our 2019 filing. So still good incentive to get our returns filed as quickly as possible, but we have some relief making sure we get the work done by September 1st. Support for businesses, temporary wage subsidy. This was one of the first programs announced, essentially a 3-month measure that allows eligible employers to reduce what they remit to the CRA in respect of wages. So the benefit is equal to 10% of wages paid from March 18th to June 19th. So we're coming up to the end of eligibility on this program. To date, there haven't been any extensions announced, and there's caps on this per employee and per employer. So the maximum amount of subsidy that you can receive is $1,375 per employee, $25,000 per employer. The subsidy is taxable. Who is eligible? The whole list that you can see from, self-employed employers, if you will, down to Canadian-controlled private corporations, so long as they were eligible for the SBD, the small business deduction. You had to have had a business number and payroll account with the CRA as of March 18th, and you had to have been paying salary, wages, bonuses, and those sorts of remuneration to the employee. The employee must have been employed in Canada. You don't need to apply for this particular benefit. You just keep deducting your income tax and your CPP and your EI premiums from the employees. You then calculate, you or someone that works for you, calculates the subsidy and the holdback at the point in time that you are remitting the employee tax amounts to the CRA. So you keep remitting the full CPP and EI, both the employee and the employer portions, but what you can do is you can hold back those tax amounts that you would otherwise have to remit to the CRA. If you don't reduce your income tax remittances, you can still calculate this subsidy on remuneration paid from this qualifying period, and then the CRA will pay the amount to you or transfer it to your next year's remittances. And the question is, how are we going to do all of that? This form is not yet available, but after the eligibility period ends, so we're watching for the rollout of this practically and the availability of this form. But once this period ends, eligible employers will be completing a self-identification form for each payroll account where remittances were reduced by the subsidy, and then the CRA will use this information to reconcile the subsidy with your payroll account, make sure that everything is done properly. And those employers who didn't reduce their remittances, they also need to be completing this form, and this will allow the CRA to credit the payroll account by the amount that of the subsidy that the employer was otherwise eligible for. So it appears that there's some benefit even though you're not actively participating in the program, but it's going to be incumbent upon eligible employers to fill out this form. So we are watching and waiting to see ultimately how this aspect of the program will roll out. I'm flipping now to the Canada Emergency Wage Subsidy Program. So now you're talking about benefits from a federal or program from a federal response perspective, more geared to business owners. This is a taxable benefit again. You'll see that across the line, these benefits and these programs, the benefit we receive, it's taxable. 75% of an employee's average pre-crisis remuneration up to this cap of $847 per week. This program has been extended. It was to end June 6th. It now goes from March 15th, continuing 24 weeks to August 29th. You have to have the employee has to have baseline remuneration. And this is calculated in one of two ways, and it is done, the choice of calculation, the employer can choose on an employee by employee basis. So you're either choosing from January 1st to March 15th as this baseline remuneration, or you're choosing from March 1st to May 31st of 2019. And the reason for the options is to accommodate seasonal employees or employees who have been off of work because of some form of disability or parental leave. So these two options are there to cover off all types of workers. If you are an employer that has continued to pay your employees, but effectively they're not working at all, you can actually receive 100% refund of the employer paid contributions to EI and CPP or QPP. So that's another interesting aspect to this benefit. And it does coordinate with the 10% wage subsidy that I talked about on the prior slide. Any benefit that you receive in the 10% wage subsidy will reduce the benefits that you can receive in the CEWS program. But interestingly, you can choose to receive anywhere from 0 to 10% of wage subsidy if you feel it's more beneficial to just work with the CEWS program. Who's eligible? Essentially, all employers are eligible. You have to have had a decline in gross revenue of at least 15% in March, 30% in April, and in May. And it's not yet defined what that's going to look like for this program as it continues into the summer. We're waiting to see what the revenue decline test is going to look like, or if that revenue decline test is going to be modified to something different. But at this point in time, this is what we're working with. In terms of measuring your revenue decline, you can choose a comparative period as either the relative month in 2019 or the average of January and February 2020. For purposes of this program only, you can choose cash basis or accounting or accrual accounting. Eligible employers are individuals, they're taxable corporations, partnerships, nonprofits, and even registered charities. If you are not eligible and you apply for this program, there are stiff and harsh penalties, including 25% penalty plus repayment for any amounts received. You are embedded in the legislation is the ability for the government to sort of name you, and any person or any business that applies for this program can be, you know, it's a matter of public record, so to speak. So it's going to be interesting to see what the purpose of that is, and there are additional aspects to the penalty regime that's embedded right in the legislation. So just to be very, very careful that if you're applying for this, you're very certain that you would qualify. The employee must be employed in Canada. And an interesting aspect of this, if you qualify for one period, say March, for example, you automatically qualify for April. You don't automatically qualify for May. You'd have to reapply for May. And so the answer is an application required, yes. And in that process, you need to attest to the revenue decline. It's made through the CRA, and we have until October 20th of this year to make applications in respect of this program. So a big program, a lot of complexity to it, and just making sure that if we're applying, you know, we're very clear and certain that we actually do qualify according to the criteria. Extended work sharing program, another program. This is not a new program, but what's happened, it's been extended to accommodate the circumstances of COVID-19. Essentially, it's an agreement between employers, employees, and the Government of Canada. It provides EI income support to employees who have agreed collectively to reduce their working hours due to developments beyond the control of the employer. Under this extended provision, it's available, so effective March 15th to March 14th of 2021, the work sharing program is extended from the usual 36 weeks now to 76 weeks. And the application and eligibility, so the application and the reporting around the program is streamlined. Eligibility is expanded. You have to be a year-round business in Canada for at least 1 year. You can be a private company or publicly held. You have to have had at least 2 employees in a work share unit. What is that? It is a group of employees, similar job function. They agree to reduce their hours of work by the same percentage. So everyone that's in this group, they choose between 10 and 60%. Over the time that the employer is going to be in the program. The reduction can vary from week to week. So 1 week it could be 10, the next it could be 60, or somewhere in between. But everyone's got to agree. as I say, everyone's agreeing to reduce their normal working hours by the same percentage and to share the available work that's left over. So is an application required? Yes, absolutely. Employers can apply through Service Canada. Another new development with regard to tax returns for incorporated business. Now, if your return was due in June, July, or August, it is due on September 1st. Similar provision if there's trust returns. Any tax balances due, installments, sort of any payment to the government in respect of your business filing due September 1st now without any interest or penalties. And we can also still defer GST remittances without interest or penalty until June 30th. I'm moving now to talk about the CEWS. This is the loan, the Canada Emergency Business Account. And most of the detail is on the next slide. What this is, interest-free credit facilities of up to $40,000 to help cover the operating costs where revenues have been temporarily reduced due to COVID-19. In the initial tranche of eligibility, the revised version of that, it was available to Canadian employers with payroll accounts in 2019. They remitted payroll between between $20,000 and $1.5 million Canadian. It was available to smaller businesses and non-for-profits alike. In expanded eligibility, this program is now available to sole proprietors who receive their income directly from their businesses that rely on contractors, and family-owned corporations that pay their employees through dividends rather than for salary. And if you're in this sandbox, then you qualify under expanded criteria that I'll speak about in just a moment. Up to $10,000 of the loan can be forgiven if the borrower pays it back by the end of December of 2022. That forgiven amount will be taxable to the borrower. Some details about the borrower. You are a Canadian operating business. You had to have been operating as of March 1st of 2020. You had a federal tax registration as of that date, and an active business operating account with the lender. So this program works in conjunction with your financial institution. So you're going to work with your primary financial institution. You had a business account open with them on March 1st, and you were in good standing as a borrower of that financial institution. Sort of in a 90-day period prior to that time, you were in good standing. You were not in arrears of existing credit facilities, and you are a going concern. You're intending that your business will resume operation sort of as the crisis solves itself or levels out, and you agree to participate in post-funding surveys. I find that interesting. Again, we are going to be participating in these programs, but in doing so, we are agreeing to a level of information sharing with the government that we may not have been accustomed to pre-COVID. So if I am falling in the first tranche of criteria where I had payroll in 2019, I have to prove that by disclosing my 2019 T4 summary with my application. If I'm going to fall under the new expanded criteria because maybe I don't have payroll, I didn't pay employees in 2019, then what needs to happen? I need to have a business operating account at my participating FI, so at where I typically do have my banking relationship. I have to have a CRA business number, and I had to have filed a tax return in 2018 or 2019. And then I need to have non-deferrable expenses between $40,000 and $1.5 million. These are operating expenses. This is rent, property taxes, utilities, insurance. These expenses will be audited. That's very clear in the application. And I'm going to do this. I'm going to go to my financial institution to make this application. The CECRA, so we've talked about the business loan, we've talked about the subsidies. Now we're going to talk about this long-awaited program that still has some pushback with regard to rent assistance. So the Canada Emergency Commercial Rent Assistance Program, it is administered by the CMHC. The CMHC has engaged a couple of partners on the application side. So if you do apply for this as a commercial property owner, you may be contacted by a couple of their partners who are administering the application along with the CMHC. But essentially, it's this agreement. It took some time to come into play because the federal government had to get all the provinces on side to find this format whereby essentially a small business tenant is going to get a rent reduction of 75% because they've experienced hardship as a result of COVID-19. And what it's doing then is it's offering unsecured but forgivable loans to the eligible commercial property owner so that they can meet their operational expenses while they're reducing their rent. So they're keeping up their end of the bargain to reduce rent to their tenant, but they need to be able to make their own operational expenses as well. So the loan part covers 50% of the rent. That leaves the landlord responsible for 25% and the tenant responsible for 25%. And so early on, the question was, well, why would I as a commercial property owner participate in this and forgo 25% of my rent? The reality is because it's very, very difficult at any point in time, and certainly in this period, to be evicting a tenant. In any point in time, there's typically, legal costs involved, maybe court proceedings. It's also that cost of then replacing that tenant. And if you look at those circumstances in aggregate like that, probably find out that forgoing 25% for a limited period of time makes sense. The commercial property owner to be eligible had to have declared rental income in 2018 or in 2019. The property doesn't have to have financing on it. I've had a few people come to me to say that. That's not the case. Properties are eligible whether there's a mortgage on it or not. And mixed-use properties are eligible. So a multi-unit residential mixed-use property, provided there's a commercial tenant in there, those properties are eligible. The agreement, there has to be this agreement struck between landlord and tenant that effectively says there's this rent forgiveness in play for April, May, and June, and the landlord is restricted from evicting the tenant while this agreement is in place. The landlord also is restricted from trying to collect the unpaid rent once the agreement, once the period of time passes, and they can't raise rent proportionally to recover what they may have lost during this period. So there's some strict criteria of what the agreement has to look like. It's also available, so where the government has a long-term lease, for example, to First Nation or Indigenous organizations, or a third party such as an airport, the lessee is eligible for the CECRA as a property owner. So that's interesting. And it becomes also available to post-secondary institutions, hospitals, and even pension funds. On the tenant side, they cannot have had more than 20 million in gross revenue, and they're paying less than $50,000 a month in rent, and their operations have temporarily ceased, or they're experiencing a 70% drop in pre-COVID revenues. Nonprofits and charities are also eligible, but the business had to have been opened before March 1st. The decline in revenue is calculated using that comparative month in 19 or the average of Jan and Feb for 2020. Property owners can apply later, and then the program will be applied retroactively. We have until August 31st to apply. And if rent has been collected at the time of approval, then a credit to the tenant for future rent is acceptable, provided that everybody agrees. So that's a bit of a 411 on the Canada Emergency Commercial Rent Program. Other support for business, we're just finishing up on this piece. So no GST and income tax audit for the foreseeable future. The CRA is still not working in that space. So if there was an audit happening, or you were expecting something to happen from March to now, we're going to see that activity cease. GST filing and payment deadlines, I've alluded to that before, extended to June 30th. And another aspect is enhanced access to credit. So Business Credit Availability Program, this works in conjunction with the BDC and the EDC, providing over $10 billion in support to small and medium-sized businesses in the form of loan guarantees. So the BDC and the EDC are cooperating with private lenders, the financial institutions, essentially guaranteeing financing up to 80%, and per business to the tune of $6.25 million. So that's the amount of financing that a business could access through their lender. They have to otherwise qualify for it, but the EDC, in conjunction, this program will guarantee up to 80% of that financing, and the guarantee fees and other fees that might be in play are being waived for a certain period of time. There's also expanded lending portfolio for farm credit. So this covers ag clients across Canada. The loan products are with interest, of course, but generous terms and amortization available. So expanded support through farm credit. Into British Columbia, just to highlight just a few things. Overall, $5 billion in support. The tax-free, the one thing that we find that's essentially tax-free across the benefit, across the programs that have been rolled out, a one-time payment for British Columbia residents. That was a long-awaited one. It took some time to roll out. Your work had been affected due to COVID-19. You have to be eligible, however, for either the CERB or EI. So that was one of the aspects of the program that wasn't initially announced. Of course, student loans, the interest frozen, enhanced climate action credit, that payment is still coming in July of 2020, and both commercial and residential customers experiencing or the opportunity to have utility and insurance payments deferred without penalties and interest. The BC Housing Program, that's another piece, that temporary rental supplement program, available for April, May, and June, so still in play to apply for. Up to $300 a month if you did not have dependents. If you don't have dependents, up to $500 a month if you have dependents. This program, the tenant initiates the application, and they have a bunch of criteria they have to satisfy. So the tenant initiates the application, and then the landlord has to participate in the application as well. With the CECRA, the federal program that I talked about earlier, the landlord initiates the application, and then the tenant has to come to the table as well. So everybody's got to cooperate for these rent support programs at the provincial level and at the federal level. Support for business. One more thing I just want to talk about, recently announced mid-May for British Columbia. I'm actually going to move past the support for business. I'm going to move past, I apologize, I'm going to talk about this slide because it's a relatively new program, really speaking to the state in which we are moving toward recovery, and British Columbia, is one of the leading provinces in Canada with regard to this. So the Minister of Agriculture and Agri-Food announced that folks in the sectors of ag, seafood, and food processing businesses, so those business owners can now access consulting and planning services to help move their business forward in recovery from COVID-19. It's a joint federal and provincial program. You should apply for this if your revenues had decreased by at least 30% as a result of COVID-19. And what's in the package, up to $5,000 in business planning services and coaching if you're an individual business owner, up to $20,000 if there's a group aspect to that. I'm not 100% clear what group means for this program, but the website, the link is at the bottom of this particular slide. And there's also additional specialized business planning services available. So it makes good sense to go to the site, have a look, and get into the queue in terms of accessing these recovery type services. Tax rates, just quickly, provincially, BC did table their budget pre-COVID-19, one of the few provinces that did introduce that new top personal tax rate, 53.5% on employment income, interest income, if you have income that exceeds $220,000 in the province of British Columbia. I just leave this as a fun comparison to the neighboring province here of Alberta. If I'm incorporated and I'm earning passive investment income inside my corporation, I'm going to pay tax at the rate of 50.67%. In the province of British Columbia, that's the combined federal and provincial rate, and then you could see those rates on through the table for other forms of income. Tax planning in uncertain times. I'm just going to conclude highlighting again, uncertain markets. We've had, dealt with some a bit of a rough ride in the spring here of 2020. So we may have some capital losses. Allowable capital losses in any year must first be applied to taxable capital gains of the current year. If you have a net capital loss at the end of the year, then of course you can carry that back 3 years or carry it forward indefinitely. We have to be aware of the superficial loss rules, and there are some opportunities, working with good advisors and good planners. If you have a capital loss and no gain, and you are in that spousal-like relationship, you may be able to transfer a loss to that person. I talked about superficial losses. Just a quick reminder, when is a capital loss a superficial loss? It is the case where you or someone that you're affiliated with purchases the same or identical property during the period that is 30 calendar days before or 30 calendar days after the settlement date of the initial sale. It's a sort of 61-day window in total. Who do we have to be concerned about? Who are we affiliated with? We're affiliated with ourselves. We're affiliated with our spouse, which of course is a common law partner as well. We're affiliated with any corporation or partnership that either of us controls, and we are affiliated with the registered plans of either of us, including an RESP of which either of us is a subscriber. Do we want to avoid the rules? A few ways we can do it. We can work, if we're in a mutual fund space, we can switch between the trust version and the corporate class version and not be concerned. If we have losses, we want to move them to a family member. We can transfer them to our adult child, parent, or sibling without concern for touching the superficial loss rules. We can donate depreciated securities to charity. That's fine. We do want to be mindful transferring things in kind to registered plans. If it were at a taxable gain, the gain is taxable to us, but the losses are denied. So we want to be mindful of that. If we're thinking about selling a fund or an ETF, we still want to maintain exposure to the asset class. We can purchase a different fund. However, we have to be mindful in ETF space, we don't buy an index fund that tracks the same underlying index. That can still get us caught in the superficial loss rules, and this applies even if the investments come from two different fund companies. For incorporated business owners, loss planning, a few things we want to think about. I'm incorporated, I've got an investment portfolio inside my corporation. I want to engage in some tax loss selling. I want to do some planning around that. A couple of things I want to be thinking about. Number one, do I have a CDA balance? That if there's a CDA balance, I have the ability to pay out a capital dividend tax-free to my shareholders. However, realizing a capital loss will erode the CDA balance that I have today. So I want to clear out that CDA balance, pay out my tax-free dividend to my shareholder, and then I'm good to go in terms of realizing any capital losses. I also want to be thinking about if I want to realize a capital loss in my corporation and I want to carry it back to get a refund against tax I've paid on capital gains in a prior year, I want to be thinking about refundable dividend tax on hand. Carrying back losses against prior year gains of the corporation can trigger a repayment of previously received RDTOH, actually reducing the refund we might have expected from the loss carryback. So we want to be thinking about that. And lastly, so a couple of things to watch for, but an opportunity in these times, those passive investment income rules that came into play in 2018, which said that if we have more than $50,000 of investment income in our corporate structure in year one, then in year two, our operating income, our ability to access the small business tax rates on our operating income is going to get ground down by 5 times the amount of excess of or unacceptable investment income we have in our corporate structure. A lot of business owners were, concerned about doing planning to mitigate exposure to those rules because it would have meant triggering significant capital gains inside their corporation. That didn't make sense, or they were concerned to do that. Now, some of those gains may be off the table. It might be a really good time to look at what's in your corporate investment portfolios, reallocate those holdings to more tax efficient options, looking at corporate class mutual funds, looking at investments with return of capital distributions, even moving passive capital outside of the corporate structure. One more thing to think about: deductions. One that's maybe opened up to more Canadians as more and more of us are working from home. Business owners and employees who otherwise qualify that are working from home, we can claim home office deductions on our 2020 tax return as long as we've been working from home. And it is by function of, it's in our contract of employment that we are required to work from home. So we might have to talk to our employers about what our contract looks like. And the employer has signed the prescribed form T2200. So a couple of criteria there to access the deduction. There is requests from Canadian Tax Foundation, from the professional accounting bodies, on and on, to say, hey, for 2020, can we look at not requiring our employers to amend our employment contracts? Can we look at some relieving provisions or some administrative relief around the T2200? We don't have any answers yet. The CRA is looking at that. For now, we're stuck with these rules. And a few other things to be thinking about. If I am a full-fledged self-employed or business owner, I can deduct my utilities, any rent I pay, maintenance with regard to the home office space, property taxes, mortgage interest, all of those things. The full suite of home office deductions is available to me. If I'm an employee, but I am a commissioned employee, the full suite is available to me with the exception of the mortgage interest. And that's often the biggest one. If I am an employee who is not earning commission income, all that is available to me is, if I'm not a homeowner, my rent is still available as a deduction with respect to the home office space, and then my utilities. But my property taxes and my mortgage interest is not available to me. So it's not as valuable as you might initially think, but certainly worth looking at. What are your circumstances? Can you qualify? Do we need to get our contract of employment amended? Will our employer sign the T2200? And then again, taking a look at what expenses we qualify based on how we're earning our money. Tax efficient investing, all I want to highlight here is that if we have liquidated some stuff by a tax loss selling, we want to be thinking about investing for capital gain or return of capital, so sort of redeploying that capital in very tax efficient manner to mitigate our exposure to the OAS clawback. That begins to trigger for 2020 when our income exceeds $79,000. So we want to be thinking about that. And then in terms of the RIF, I talked about the ability to take that reduced RIF minimum for 2020, but what if we take the original minimum? Maybe we don't need the cash flow regardless. It's an opportunity now for us to move that bit of capital into a tax exempt space such as TFSA if we have the contribution room, or maybe into the more relatively tax efficient non-registered investments. So some things to be thinking about. I have the chance to take the reduced minimum, but maybe I should still take that original. Withholding tax isn't going to apply, so I've got full suite of withdrawal to work with, and maybe I can move it into a more tax efficient space from an investment perspective. Estate planning, almost in conclusion here, I just want to comment that now may be a very, very good time to take a look at an estate freeze. This sort of global pause on much economic activity has continued to depress valuations for many active businesses. And if the current valuation of your business is sufficient to manage your lifestyle through retirement, and I say that in quotes, and you still anticipate growth of the business over time, an estate freeze can very effectively transition assets to the next generation on a tax-deferred basis now at a low valuation, well limiting your future tax liability on your on your passing, so the tax liability to your estate, and in particular, high probate provinces such as British Columbia, doing that in a manner where you're minimizing probate as well. I mean, there's other planning that we can do around that, but certainly a very, very good time to look at an estate freeze. And with that, I'll just conclude just reminding, now is a fantastic time to be looking at our wills, all of our agreements, our domestic contracts, our shareholders agreements, our plan and policy designations, our power of attorney documents. Let's take a look at that. Do they reflect our wishes? Do they reflect our circumstances? Are they aligned? If I'm engaging in tax loss selling, let's make sure still what's governing my decisions are my investment objectives and my long-term goals. Tax planning is important, but it is a secondary factor in making investment decisions. And then really working with our advisors to be thinking about our planning opportunities. Advisors such as Mike, for example, to be thinking about planning opportunities ahead as this immediate health crisis stabilizes, and we're seeing that in particular in the province of British Columbia. With that, I'll say thank you for your time, and I'm going to turn the screen back to Mike.
Thank you very much, Rebecca. That was excellent. As you can see, or as you've heard here, the benefits out there are vast and complicated. Do seek advice, especially business owners and even individuals. If you're going to apply and take advantage of these different features and benefits, to make sure you don't get down any complicated roads that might cause you grief or penalties later. And also remember, some of these things are repayable. And as you reopen the business and as the business comes back to health again, it is going to add to your overhead of running your business. So very complicated, very important to do some extensive planning and get some advice, especially from people with in-depth knowledge around the tax implications and some of the potential penalties if your application or if the information you supply is not currently up to date and current. So with that, we're going to let you go. As always, join us for these deep dives every week. We try to put these out on Friday. Of course, Tuesdays we put out our live market updates. If you have any questions, you can find a link to our emails down below, or just go to mikeonmoney.com. It will take you to our contact page. We're always happy to answer any questions. There was a lot of information in the presentation. If you'd like some specific information that relates to your situation, just reach out to us. We'll happily get that to you as well. Anyway, thank you very much. Stay safe out there, and we'll talk to you soon. Thank you. Okay. Rebecca, if you're still on there, I've paused the recording, so it's the recording's done. Thank you very much for your help today. You did an amazing job as always, and I'll be reaching out to you as we put the video up live after Sophia gets to edit it. And as always, thank you, and I'll be reaching out to Elijah as well. He had sent me a bunch more information, and we'll be talking more on the funds and business going forward. Again, thanks everyone. Talk soon. Bye.